everyone. We are on the weekend, Saturday, Sunday afternoon, 3 p.m. class, and today is Sunday afternoon. Yesterday on Saturday, we completed month-end activities. So we have been doing month-end activities. We have covered accruals, prepayments, provisions, bad debts, and all those things. And we have covered up till cash flow analysis. We have done all that. Yesterday, we covered correcting entries, headcount report, and cash flow. You must have got recordings for that in case you were not here. Now, I said that we have to do some practical as well on accruals, prepayments, and provisions for bad debt, but I'll have to give instructions on those things, accruals, prepayments, and bad debts here. So those are something, and some reconciliation as well. 4 items. We'll do some practical. We have not done the practical in this class. Normally, accruals we do in the class. We give you certain, like what you call invoices, like I 13, 14 invoices to you, and we give you the cost center report for this month, which we are closing right now, and also I give you the last month's accruals that we did. So based on that, we have to come up with the figure to accrue for this month before we close the books. And then we discuss with each other like exactly why your number is different as compared to the other person, what mistakes each person is making. So we're learning from each other's mistake. It's not a test basically. It's just the way to see how people can think and what mistakes can they make. And from that, we're taking the learning with you. So when you are in the office, you know that what exactly is required and what to do in a particular scenario. So we try to give you a little bit of practical exposure in accruals, prepayments, bad debts, and reconciliations. So we are moving on to the month-end reporting now. And remind me at the end of the training or maybe in the next class when more people are here, I'll give you these month-end activities to do and also the instruction on them. We have not done them, right? Yasir or anybody else, can you tell me? We have,
No, sir.
I've not given you anything on that yet, right?
Yeah.
Right, okay. So I'll give you the instruction on those, okay? Now, coming back to month-end reporting now, every company nowadays does reporting. Normally, we do external reporting to the external stakeholders every year or twice a year, interim report and final report, to which we conform with IFRS and GAAP and all. And that's for the shareholders. Whenever company is listed on the stock exchange, they will generate that report. Now, here we are doing the monthly management reporting because management reporting is about decision making. Management wants to know how are we performing right now so we can take the corrective action. We don't want to wait till the end of the year to see how we performed and then take actions. So nowadays every company does monthly reporting, monthly closing. Now, when we talk about the multinational companies, I would like to tell you the structure, how monthly reporting is structured in terms of the monthly timeline. So when you join the organization, they will give you in the beginning of the year the full timetable of the whole year, in which they'll tell you in which month we will closing the books. They will keep it flexible. They will not try to fix the dates of closing. Okay, so they will say that the timetable that you will be seeing will say something like WD1, WD2, WD minus 1, WD minus 2. So what does that mean? Each month, let's say we are sitting in the month of um, July right now, so I'll show you the calendar. I don't know whether you can see my calendar or not. But if you are sitting in the month of July, the last day of July is 31st July is on Sunday, right? So they will not close the books on Sunday, 31st July. They will close a little bit earlier than that, okay? So 29th, which is Friday, is the last working day of July. They will not close the book on Friday, 29th, right? They will close a few days earlier than that. So they might decide that in the month of July, we'll close the books on, let's say, 27th of the month, all right? Now, if they decide 27th of the month to be the date, this date they decide each month at the beginning of the month. So, they will call this 27th of the month as workday 0 or workday 1. Depending on your company, you have to see what they call it. I have seen some companies calling the day on which they close the books as workday 0 and the next day will be workday 1. Alright. Some companies, when they close the books because they close it early, like 12 o'clock or 1 o'clock, they still have the whole day to work on. They call their workday 1 on the date they close the books. So you have to see how they define the workday. So let's say they're saying workday 0 on the day on which they close. So 27 becomes workday 0. So the timetable will say that this item is due from you to some other person on workday minus 2, let's say. So workday minus 2 means whatever they decide to be the closing date, 2 days before that is minus 2. So in that case, if they decide 27 to be the workday 0, then minus 2 would be 25th, which is Monday. They will not include Saturday or Sunday in the workday count. Okay, so workday means working day. If they say this report is due on workday 3, right, and we are closing the books on 27th as workday 0, and workday plus 3 would be the date of the report. So it will be 28 on Thursday, 29th Friday, 30, 31st will not be counted. First Monday will be the third working day. So it is due on the 1st of August. Alright, so they go like that. Workday 1, workday 2, workday minus 1, workday plus 4, plus 3. It goes like that. So whenever they close the books, so now they are flexible to decide at the beginning of each month when would they like to close the books in this month. So they're not committed to any figure or any particular date that in July it always will be 27 or 28. They don't want to commit at the beginning of the year. So at the beginning of the year, you will receive a schedule in which it will say the flash report is due on workday plus 2. This thing is due from you to other person on workday minus 3. Like that, they will mention to you in that report. And each month, then they will decide what will be your workday 1 or workday 0. I hope everybody understands what I mean by that. Workday 1, workday 2, and how the schedule you will see in the company, it will be same like workday 1, workday 2, workday 3, workday minus 1, minus 2. So you should be able to figure out what they're saying, what they're talking about. Everybody clear?
Sir, here workday minus 2 will be 24th.
If they decide 27 to be the workday 0,
Yes.
right? Workday minus 2 will be 25th,
Okay.
right? Because one day minus 1 is 26
Okay.
and minus 2 will be 25, right?
Okay. Okay, sir.
And minus 3 will not be 24, will not be 23, minus 3 will be 22, Friday,
Okay. Okay. Got
right?
it.
They're talking about the work day, not the weekend, not the holidays.
Okay. Okay, sir.
All right, workday plus 1 will be 27 is 0 workday, so workday 1 will be 28, workday 2 will be 29. If they decide to call workday 27, or if they decide to call 27 as workday 1, then workday 2 will be 28, workday 3 will be 29. So you have to see
Okay.
what they call on the day they close the books. Sometimes, I've seen in the companies that I've worked for, if they close the books in the later half of the day, like after lunch, like 2 or 3 o'clock, they call that as workday 0, because they don't have any extra time to work on items on that day because it's gone almost, the day is gone, right? But when they close the books, let's say at 10 o'clock or 11 o'clock or 12 o'clock in the morning, then they call that as workday 1, because they still have half a day to work on things, right? So that's the logic behind it. But you have to see in your company what do they call on the day they close, whether they call it as workday 0 or workday 1. From that day, you have to count. If 27th is they're calling workday 0, then workday minus 2 will be 25th. 26 will be minus 1. 25. If they call 26 to 27 to be workday 1, then 2 days before that will still be 25th, but it will call workday workday minus 2 still, right? Workday 1, workday 2, workday 3. So that will be workday 3, right? So 2 days before, 2 days after, whatever the day they close, that's what it is basically. So workday minus 2 will still be 25th, although they call workday 1 on 27th. 2 days before that is 25th, right?
Okay,
Yeah.
sir. Got it.
Got it. I don't. All right, you understand? So that's what it is basically.
Yes, sir.
Whatever
Thank you.
they decide to be the closing date, 2 days before that, or one day before that, or 2 days after that. That's how they say. You'll see in almost all the companies the same thing. All right. Now, um, first of all, I'd like to tell you what is your role at the time of closing, and when we close the books, just before we close the books, what we are supposed to do. Can you all bear with me? Just a second. I will open the files as well. Right, you can hear me?
Yes,
Hello?
sir.
Yeah, okay. All right. So, month end closing, I would like to tell you first of all what needs to be done. Let's say they decide 27 to be the end of the month, right? You are assigned, let's say, about 8 or 7 cost centers. Now, you should be looking at your cost centers throughout the month. You should not leave it till the end of the month. Because if you leave it till the end of the month, it will be too much a task, because there are so many things coming in the cost center, each cost center, that you will not be able to get the explanation for them. You'll not be able to get them corrected. And plus, being a proactive person, they expect you to be on top of the things. So as soon as you see something wrong in there, they expect you to rectify the errors promptly. So that's why every 2 or 3 days you should be looking at the items assigned to you. They might assign you GL codes, they might assign you some reports, they might assign you certain cost centers, business areas. Whatever you are assigned, you will be responsible for total month end activities and reporting for those items. So in that case, you should not be leaving it till the end of the month. You should monitor them throughout the month. Now, just before the end of the month, let's say 27th is the closing date. So before 2 or 3 days before that, you should be looking at your cost center report, for example, and then you should decide whether do I need to do anything on this before we close the books. You should see whether do I need to accrue anything, whether do I need to do anything for the prepayment adjustments, whether do I need to do any correcting entries in there, adjusting entries in there, provision entries in there. Do I need to do anything on this, or is it final? Now, if you decide that I want to do some accruals here, prepayments, then you have to have proper backup support for them. And on that basis, you will make the entries. Now, because you have seen the report just before the closing, you should be expecting those numbers in your reports after finalizing, after the books are closed, and when you generate the reports, you should be expecting those variances. You should be expecting those numbers in your reports. You should not only be expecting, but also you should be having explanation for each item in your report. So you know if this variance is high or low as compared to the plan, then what is the reason behind it. So you should have all investigated before the end of the month. You should not start your investigating after the month. Otherwise, it will be too late for you to start investigating. You will not have that much time because they need results soon after the month end. So that is something advisable for any analyst to be on the top of the things throughout the month, and especially just before the month end when he's closing the books, he should be seeing his reports, items assigned to him, and then decide what needs to be done before we close the books. Right? So that's something. So you have already seen the report. Now I'll show you what I mean by that. Let's see if I go to cost center report. Let's say this cost center is assigned to you, and now we're going to close the books for, let's say, July. And oh, I have to start again because it was open for a long time. I'll show you again. So log on to SAP. Okay, I go to accounting, controlling, cost center accounting, and we go to the information systems, reports, plan versus actual. Let's say I'm going to run the report assigned to me. So controlling area 1000, year 2003, let's say. Let's say this is period 7 and this is to 2022, and let's say we run the report. So I should be looking at this report on a very regular basis. Every 2 3 days I should be looking what's coming in my actuals here. Plan is fixed because plan is already there for since last year. Plan is already fixed. We know what should be coming in the system. This is what should be in there. This is what is in there. All right. So let's say I am looking at this report. Let's say on the 10th working day, and I see there's no plan, and I see the cost over here. I should investigate why this cost is coming. Is it a wrong coding? Is it something that should not have been here? Or if it is here, then why it's here? Why we don't have a plan? Or is it just a timing that this item is covered in the next month, but we are doing it earlier? So I'll write a comment over here. It's timing. I know the reason for it. If it is not timing and we have to incur this expenditure, why don't we have the plan for it? Why do we have to incur? We have to know the reason for it. So I already know the reason. So just before after the month end, I will put my reasons over there. I know what the reason is. So that's the sort of thing you should be doing, right? Now, if you see something like this over here, that's 284. Let's say we are on the workday 10 right now, and I'm seeing 284 in the plan, but I'm not seeing in the actual. I cannot do much about it, right? I cannot do because this actual might come on the very last day before the end of the month. So you cannot investigate this one, but still you can investigate whether any invoice has been received and posted somewhere else maybe. But then I will leave it till the end of the month or near the end of the month, right? So I will still expect this invoice to come in before the month end. Now, if I'm looking at just before the month end, on the 2 days before the month end, then I'm interested in this one to know whether I need to accrue this one, because I need to find out if this item has been received and posted somewhere else, then transfer it out here. If this item has not been, if this item has been received but invoice has not been received, I need to accrue for it, right? So then I need to do some work, which we have discussed already when we were discussing the cost center report, how to accrue for things, how to make sure that cost center is complete and what analysis we do. So then we have to accrual, when we do the accrual over here for this item, this variance will go away. So just before the month end, we look at our report and see what items are coming in here. Any item which have high variances over here, favorable or unfavorable, we should be knowing the reason for it. And any item that we need to accrue for, adjust or provide, we do all that thing in there before the month end. That's what I mean. So you should be doing all this. Now, when the books are closed, no more entries are possible in here. And when we look at the reports after the month end, we should be expecting those numbers and we should be expecting those variances in our reports. Of course, because we have seen it, we have made the entries, we know what our final numbers would be. So that's what I mean. So that is your role. Whatever item assigned to you, before they close the books, you have to make sure that everything is okay in there. Anything needs to be accrued for, prepaids or anything taken to be taken care of, any other things to be taken care of, you have already done that, right? That's what we have to make sure. All right. So now once the month end is closed, let's say they close it on the 27th of the month at 1 o'clock, but the system will be closed. No more entries will be possible after that. Okay. Then after 4 or 5 hours, a report is going to come up, which we call normally flash report. All right. The first report that comes out soon after the month end, after a few hours, they call it a flash report. Why do they call it a flash report? What is the purpose of the flash report? What are the contents of the flash report? And what is your role in the flash report, that you have to know for the interview purposes. Okay. So that's what we're going to discuss here. Now, this flash report that comes out soon after the month end can be for the whole company, can be for the departments or segments or business area. We are talking about the flash report of the whole company because that holds more value from the interview point of view. So you are responsible for looking at the flash report for the whole company. You must have seen there's a flash report for sales department, for marketing department, for production department. Departmental flash reports is there, which each departmental manager will be producing. The flash report that comes out soon after the month end, one senior financial analyst will be producing it and putting it on the shared drive. So what happens after 3 4 hours? This flash report is created from the numbers that are sitting in the system, and this report is called flash report because just like a flashlight, when you flashlight is not a permanent light; it's a temporary light. It only reflects whatever is available at that point, and when the light goes away, everything is in the dark, right? So it's not a permanent light. Similarly, the flash report is not a permanent report. It's just like a flash comes in, and it is the purpose of the flash report to tell everyone that if we close the book permanently, these are the numbers sitting in the system and these will be finalized. Do you all agree with this or not? That's the purpose of the flash report for now. All right. So whoever creates the flash report, he will put it on the shared drive and a note will come to all of the concerned persons that the flash report is ready for you to review. Please write your high level comments by tomorrow. So they give you very small time to write the high level comments because they know everybody in their area know their reports and what to expect in those numbers, and they already have the reasons for the variances there, so they can easily write it. Now they want high level comment, they don't want detailed comments in there because they're not really analyzing anything. They just want to have a comfort level that all the variances, all the numbers that we are seeing in the flash report is final and they are all okay with it. Nothing needs to be changed, right? So when this report comes out, let's say it comes out on at 5 o'clock or 6 o'clock in the evening, right? Then they reopen the system. they reopen the system for any adjustment that people might want to make. So if I look at the flash report and I see something wrong is posted in there after I last checked it, or I find out I probably have missed any accrual or may have miscalculated something, I want to reverse something or do some adjustments or make some more entries, then it is again open for 24 hours. So everybody looks at their number. So everybody is supposed to look at their area and validate those numbers. How do we validate those numbers? We validate those numbers by putting high level comments. I will show you the flash report in a minute and I'll tell you exactly what your role is, right? But I'm just giving you an overview what flash report does and what it is for. All right. So everybody will start looking at their number. It is impossible for one person to write the comments about every item in the flash report, right? Now, first thing, I gave you the definition of the flash report. It's the first report that comes out soon after the month end. It's by no means final. It is just for the people to look at it and see whether we should finalize it now or should we make some changes to it. That's the purpose of the flash report. In the flash, it gives you the picture, what we have in the system, right? Flash report can be for the whole company, it can be for product, it can be for segments, it can be for departments. Every department, it all depends on the company what they decide to create the flash report for. We are talking about the flash report of the whole company. Now, second thing, we have to know what are the contents of the flash report. Contents of the flash report, because we are talking about the whole company's flash report, then the contents of the flash report will be decided by the managers what they want to see in the flash report. There's no rules to follow, there's no confirmation with IFRS or GAAP here. They can decide the format, they can decide the contents. Generally, the flash report will contain financial and non-financial information both. What do we call by the financial information? Financial information means dollar values of the items. And non-financial information means quantity, number of persons, right? The consumption in kg, consumption in megawatts, something like that, right? So financial and non-financial information both can be covered in the flash report. There could be items from balance sheet, from income statement, from other areas as a part of the flash report contents. So flash report contents will be decided by the management. They can keep on adding new items, they can keep on taking out items from there as per the requirement of the management, right? So that's the flash report. So now I gave you the definition of the flash report, the contents of the flash report, right? What we are talking about the whole company's flash report here. The next thing to know is to know the timing of the flash report. It normally comes out on workday 1 or workday 2 maximum. It's finalized by workday 1 or workday 2 depending what you call workday 1. Right, the next day it is finalized because they want you to straight away start on your analysis work, so they don't want to take time in doing the flash report. So once the report is there after 4 hours, they will reopen the system for another 24 hours. Let's say up till next day 12 o'clock or 2 o'clock they will open the system. Then next day at 2 o'clock they will finally close the system. Now no more entries will be possible in the system. If anybody discovers anything is wrong in their reports, then they have to talk to the manager concerned, his manager, and then they will decide whether they want to open the flash report and make the changes to the system, or they will take the manual effect of it, or they will take the effect in the next month. So the managers are going to decide now whether they want to make those changes or not. So it will not be in your hand anymore. Now, when the first flash report comes out, all of you should be looking at your areas to see. You should already be expecting those numbers in there. But in case you find something wrong in there, some wrong entry has been posted by somebody, or maybe you forgot the accruals, or maybe you have to have some adjustments done over there, and you discover that something has to be done from the practical point of view or from practical experience, if you're working in the company sitting there, we advise you that you complete everything before you leave. Because normally what happens, you might say, okay, I've got three more adjustments to make, and I've got up till 2 o'clock or 1 o'clock in the morning tomorrow. So I'll go home and I'll do it from home. And you go home and then you try to log in. Now, because of the month end, VPN is very busy, and you find it difficult to log in. Even if you log in, it keeps on disconnecting, or there's some problems there in connection. So you will be under stress. Then what happens? You say, okay, I will do it in the morning, right? In the office, and you go to the office and you're just settling down, And as soon as you settle down trying to do this, these items remaining there for flash report, your boss might come to you and say, I have something urgent for you. Can you please come to my room? And then you are under stress when to do these adjusting entries for flash report to complete. So that's why it's always advisable to first complete everything, then leave, so that you have at least it is out of the way. Now let's see how the flash report looks like. What are the contents of the flash report here? And we will be learning certain analysis on them. So let's see. We have given you a folder which is called for student 1 in your ICIT Canada folder. So there's a folder that Asif gave you, old folder ICIT Canada. In there you will see a folder called for student 1, and in for student 1 we have some folders and some files. In the files you will see the flash report as well. So if you see over here, down there, flash report BPM Canada mass market, right? Flash report BPM Canada mass market, that's the one we're talking about. So I'll open this one here. So we will discuss your junior role here and your senior role here. Okay, in the junior role, you're only responsible for your area only. In the senior role, you are responsible to construct it, to populate it, to make sure it's all complete, accurate, and valid. And then you have to, you are more accountable for it. So let's see. Now, if you look at this flash report, we have got so many tabs in there, which looks scary. Remember one thing, none of the figures over here are typed by anybody. It's all coming from some sources, some formulas, and somewhere. So we will try to understand what exactly this report is, and it will be a very good experience because exactly the same thing you will be doing in the workplace. The purpose of this training is to show you how things are done in the real office and how you're supposed to do the task. Now, I'll first try to explain you the structure of this flash report so you understand what is in there. The first tab that you see is the checks and balances. These checks and balances basically are there to ensure that when we update this report, all the numbers have been updated. So when we see these texts as 0, we are sure that my flash report is updated from the sources I'm trying to update it from. Alright? And it says over here, please make sure that gray areas are 0. And it gives you some instructions over here. So if they are not 0, then in those areas we can see the differences could be there and we have to resolve the issues before we, because if the differences are there and the numbers are not correct, how can I do my analysis work on them? They are not correct. So first of all, we have to first make sure that these numbers are all 0. So that's the checks and balances. The second is just a blank one. Now these gray ones, all these gray ones, they are different segments. So let's start from just besides the yellow, the first one here. This is the flash report for business for British Columbia, BC. All right. So we had Canada East and Canada West. Canada East was made up of Manitoba and Ontario, and Canada West was made up of BC and Alberta. Right. So you can see this is the BC flash report. This is your Alberta flash report. All right. And you see the consistency in terms of the structure. Same report, so it's easy to consolidate, easy to read. So BC flash report, Alberta flash report. The total of BC and Alberta is equal to Canada West flash report. You can see the numbers coming over here will be coming as Alberta plus BC. So these two added up into the West. So BC flash report, Alberta flash report is equal to total West. Then we have Canada East flash report here. So when we populate Canada East, that will be total competitive business, which means East plus West is your total competitive business. You can see East plus Alberta plus BC. That is your total Canada competitive business. Now, in this business, there's an oil and gas business, and in here we had competitive business and we had regulated business. So total comp is your competitive, which means more than one players are there in the market. So demand and supply will decide the oil prices. All right. So more than one players are there in the market. Whereas in the regulated business, which is this one here, your regulated business basically is the one where you have monopoly and you are not allowed to increase the prices on your own. If you want to increase the oil prices, then we have to send the application for price increase to the ministry and they will approve if we justify why we want to improve. If they don't think that we are justified to improve, they will not allow. Because since we are monopoly, we cannot just charge whatever we want, and that's called regulated business. The prices are regulated by the government. All right. So we had the business in East and West as competitive business, and in Alberta we had a regulated business as well in the West. So BC plus Alberta is equal to West, plus East and West is equal to total competitive business, and competitive business plus regulated business is equal to total Canada. And you can see over here we have regulated plus comp. So that is the structure. You can see it's very easy now. All these gray ones are different segments flash reports, and it is up to the management what they want to see. For example, BC persons will be person sitting in BC will be preparing his flash report. Person sitting in Alberta will be preparing his flash report. This will be the total of the comp. You are sitting in Canada East, so you are responsible only for Canada East flash report. I'm talking about the senior financial analyst, okay? Senior role. Total comp will be West and East together. Regulated business person will produce his flash report, and total Canada mass market will automatically be created, right? So we need persons, each individual persons, senior financial analyst creating the flash report for their own areas, right? We need one person before the manager to look at the total comp, total West, right, and total Canada, so that they can see everything is fine in there before the top management can use any of these reports. Now, your role as a financial analyst will only be confined to your area. For example, if you are sitting in Flash Canada East now and you are responsible for cost centers, marketing, sales, and operations, so you will only be responsible for this area only. All right. Person who is responsible for margins will be responsible for revenue, maybe cost of sale, margins, right? So everybody will be responsible for their own areas to validate. Remember, this report is generated by the senior financial analyst, and this is put on the shared drive, and you will be receiving the message that this report is ready for you to, review, and then give your high level comments about your area. So how do we validate whether our numbers are fine? We have to give high level comments. So let's see. Before I show you the high level comments and your role, let's see the contents of this report. Okay, what exactly do we have in this? And that's what your experience is. In the interview, when they ask you what were the contents of the flash report, what exactly were you reporting on, you should know how it looks. First of all, this report should come to your mind. And what are the contents of this report? You can see all these things in there, and you can easily speak when you know the numbers and you see the structure. So let's see on the top over there, we have actual month to date, plan month to date, and this report is for 2009. So 2008 is your last year month to date. LE2, what is LE2? It stands for latest estimate 2. When we have a plan, we create the plan for this year, and we created it last year, right? In 2008, they must have created the plan for 2009. So that is the plan. And when in 2009 first quarter goes by, many factors might change which require revision in the plan. When we revise the plan for the first time, we call it LE1, latest estimate 1. Some companies call it YEE1, year end estimate 1, or they might call it um, LE, LV1, latest view. Some companies call it LV, latest view. Some call it LE, latest estimate. Some call it YEE, year end estimate. The thing is the same. You're revising the plan for the first time, it's one. Revising for the plan for the second time is LE2. Third time is LE3. Normally, companies make three revisions in a year, but it all depends on your company how much they make. All right, how many changes they make. So that's your second revision of the plan. All right. Now that is your monthly numbers for the month of May. This is a report for May. So these are May numbers only. Month to date means from the beginning of the month to the end of the month. That's your monthly for each of these items. This one over here, LE2 BW, Plan BW, and 2008 BW. BW stands for better or worse, favorable or unfavorable, right? So This is your variance. LE2 better worse means LE2 minus your actuals. Plan better worse means plan minus actuals. 2008 better worse means 2008 minus actuals. We always minus the actual from the item, okay, to get to this number here. So LE2, plan, and 2008 better worse. That is what I said. We minus the plan minus actuals for expenses. For revenues, the other way around. Okay. Now you can see all these numbers up till here are month to date. Here we have the same headings but for year to date. Actuals year to date, plan year to date, LE2 year to date, 2008 year to date, and then the variance against each of these year to date. Year to date means from January to now. So January to May. Alright? So that's your year to date and that's your monthly. When we do the analysis work, we have to do and explain the variances both for the month and for the year. Right? Normally you will see after first few months of the year, your yearly various reasons remain the same, only the numbers change. Unless some new factor come in and we incorporate that in our explanation. Otherwise, mostly the wordings remain the same. Now, once we have seen the structure of the headings, let's see what are the contents in rows. The first one you can see is revenue. And we have different sources of revenue, gas, electricity, and others, total revenue. That's your total revenue. Then we have cost of goods sold, gas related, electricity related, and then total cost of goods sold there. Then we've got the margin, which is your revenue minus cost of goods sold is your margin. That's your margin, and then your margin percentages for both gas and electricity, right? Then we have operating expenses, which is your overheads. These are your cost centers, right? So sales cost center, sales operations, and marketing. Total cost to acquire. You see, they've divided these into cost to acquire, cost to serve, cost to retain, overheads. All right. So sales, marketing. Now under sales, there could be five or six cost centers. Under marketing, there could be five or six cost centers added together, right? That structure they will tell you in the company what marketing cost centers are there, what operations cost centers are there, and if they assign you, you will know them, right? So sales, marketing, these are a cost to serve. So let's see what is cost to acquire, cost to serve, and overheads. First, let's see the whole structure. So that is your total overheads, departmental overheads. This 3572 is divided into cost to acquire, cost to serve, and overheads. Total matches over there. And you can see simple sum if formula is there. And then we have direct allocations and indirect allocations. I told you what those are. Direct allocations coming directly from the corporate, indirect allocations coming from different segments, right? So those are, and then total operating profit, right? Up till total operating profit, we have all the financial information, dollar value, profit and loss related financial information. Then we have ending customers. This is non-financial information. These are number of customers. How many customers we had at the end of the period for gas total, for electricity total. How many new customers we made in the period in this month? That's year to date. That's month, right? Normal churn. So what is churn? We'll tell you in a minute what churn rates is. We'll do all these analysis. Somebody will do all this analysis on them, right? Then we have got adjustments. Then we have got renewal churn. Then we have got paper in. Then we have normal churn rate percentage. Then we have consumption. How much gas was consumed in gigajoules? How much electricity was consumed in megawatts? All right. You can see all this is non-financial information. That's what they want to see in their flash report. These contents that you're seeing are not conforming IFRS or GAAP or anything. These are the requirements of the management that they want to see all these numbers in here. They can change this anytime. They want to add something new here, they want to delete something from there. They can always make whatever changes they want and the way they want. They can change the structure as well if they want. We also used to have the head count here as well, but since the recession was there and a lot of people were losing their jobs, we took them off to avoid dissatisfaction in the company. Otherwise, there was a second head count as well. How many head counts do we have in each segment? Right. So now you see the structure of the flash report. Since this flash report is for the whole company, you are seeing over here revenue, cost of sale, and every departmental expenditure and all the items relevant to the whole company. If this flash report was only for sales or for marketing or for any of the departments, you will be seeing the contents of those departments and things important in those departments in the flash report, right? So now you know the structure of the flash report and who decides the structure of the flash report. So now we know the definition of this flash report, the timing of the flash report, the contents of the flash report, right? And the purpose of the flash report. The purpose of the flash report right now is for everybody to look at their numbers and validate whether these numbers are fine or not. So what they will do, they will open the system again. So if anybody finds anything wrong in here, then they can still make some changes in the system, and then the final flash is going to come up. All right. So after they close the books on the second day, then final flash that comes up, and they call it by a different name. Like in our company, they used to call it Outlook report. The same flash report, when it was finalized, was called Outlook report. All right. In some other companies, it is called final flash report, or they might give any other name. But it's the same thing when the flash report, which is the whole company-wide report, or departmental report, or product-wise report, when it is finalized, now no more changes are going to come in. That they call it by a different name, or maybe by the same name. You have to see what they do in the company. It's all management reporting. They decide what they want. But in most of the companies I worked for, we used to call it by a different name. So we used to call it Outlook report or final flash report. So tell me, any questions so far? No questions? Anyone? Are you all with me?
A lot of stuff to go.
Right. I know, but you know, whatever I'm telling you, exactly same thing you'll be doing, and it is the easiest task in the world.
So the best thing is like this is for whole company, right?
Yes,
So we will be doing only part of it, like maybe revenues, COGS, or some other.
yes, exactly. So whichever area is assigned to you, you will only be responsible for that area only. So we are discussing over here your junior role and senior role both. So in the
Oh,
junior role or normal analyst role, I won't call it a junior role. Normal financial analyst role, you are only responsible for your area, and that's it, right?
okay. Sir, one more thing, like we
Yes.
have the first four actual LE2 plan 2008, right? So then we are going for best or worst. So how
Mhm.
we calculate that best or worst? Like it
I
should
told
be
you,
like
best of worst LE2 means LE2 minus actual,
LE2 minus actual.
right? In this case, revenue is actual minus LE2. For the expenses, it's LE2 minus actual for LE2 better worse. For plan, it's plan minus actual. For 2008, it's 2008 minus actual.
So all from actuals we have to deduct.
Yeah, exactly. You are seeing the variance against the actuals for all these items.
Okay. And what is this? There was a term called churn rates or churn
Yeah,
something.
that we're going to discuss all those things in a minute,
Okay.
right? First, I was just showing the structure of the items, okay? So
Yeah.
now you know the structure of the items, okay? Now we'll do some analysis work in which what you're asking. We'll be answering all those questions in there so that we can have some experience of some keywords in there. So first of all, I was telling you that this report that you see over here has to be generated by somebody, has to be finalized by somebody. All right. Once it is there for you, your role starts, and you will be only responsible for your area, and you should be expecting those numbers because you have seen those numbers just before the month end, and you have done all the entries, adjusting entries, correcting entries, accruals, prepayments, whatever entries required. You've all done it, and after making the entries, you should be expecting those numbers in your reports, right? So it should not be difficult for you to answer the questions or give the comments on these numbers. You already have them. Now let's see some items over here which require some explanation. For example, we see the word CTA, CTS, CTR is also there, and overhead. What is this? Now they have divided the overheads into different components called cost to acquire. CTA stands for cost to acquire. CTS stands for cost to serve. CTR stands for cost to retain, and overhead is all items which are not related directly to the customers. Now, what is cost to acquire? Now, in older days, we used to write revenue minus cost of sale, gross profit. Then we used to list down all the expenses, selling and admin, salaries, rent, right? Stationery, billing, this and that, and then net profit. Then they said it's very difficult to pinpoint who's spending on traveling, who's spending on utilities. So it's very difficult to pinpoint and it's very difficult to give the budget. So they created departments or cost centers. They assigned the cost center number. So now every person who is responsible for any expenses, when he posts his invoice or his expense item, he will go to the GL account for, let's say, traveling, but he will put his cost center number there. So we now know which cost center is spending on traveling how much and what is their budget. We can assign budget to this, so we can control the expenses there now. Then they saw that these sales and marketing people are given a big budget for advertisement, for incentives, for promotions, and they have a lot of products to give out to new customers, you know, prospective customers. They've got a lot of money for promotion, incentive, and advertisement. But nobody was seeing where they're spending it and what is the overall impact on the increase in the sale or on new customers, right? So what is the impact of those advertisement expenses and all? Those most of the expenses that they had for advertisement and marketing, those gift items and everything was going to their friends, families, and this. Nobody really cared what's happening here. So company said, let's make them accountable. So now what they do basically, they add up all the sales and marketing related efforts or cost and they divide by the new customers that they make. That way they can find out how much are they spending to acquire one new customer. And now they can control the activities. They can see in the market how much the normal company spends to acquire one new customer and how much are we spending to acquire one new customer. That way they can monitor it and they can see total cost to acquire. So cost to acquire basically cost to acquire a new customer. So only sales and marketing related efforts targeted to acquire new customers is classified as cost to acquire. All right, and they add up all this thing and then they will divide by the new customers to find out how much are we spending to acquire one new customer so company can make some efforts to bring it down. Everybody understands cost to acquire?
Yes, sir.
Yes, sir.
Right. Then they have cost to serve. Once you become the customer, then whatever activities companies perform to serve the existing customers, they classify as cost to serve. Again, the purpose is to minimize the cost to serve. And you can see all these activities, sales and marketing can also be cost to serve if these activities are targeted towards existing customers. Sometimes, we provide some incentives and promotions to existing customers only, right? And all those activities targeted towards the existing customers will be classified as cost to serve the customers. Similarly, pricing, billing to the customers, their account information, and all those things, utility offs, all these things are classified as cost to serve the customers. Now, let's say somebody calls the call center and says that my television is not working or internet is not working. They will send somebody to fix it, but they're not charging you. But they have to pay for the service to somebody, right? So this is called cost to serve the customer. If you call the call center 10 times to get your issue resolved, which should have been resolved in one or two calls, we are really spending a high amount on cost to serve because each call counts, right? So cost to serve is high. We want to minimize the cost to serve. So that's why they classify all those activities which are targeted towards the serving the customers. We divide them by the number of customers we served and we know how much are we spending to serve one customer. So we want to minimize that cost. Okay. So now you know what is cost to serve, cost to acquire. Then there's something called cost to retain the customer, CTR, right? What is that? It is the cost that we incur to retain the customers who is trying to get away from us. For example, somebody calls us and say that I'm going to Rogers because Rogers is giving a better phone, giving me free stuff, free 2 months or 3 months or whatever, or and a free phone. So we say, okay, no problem, sir. We can match that or we can better that. We can give you a better phone. We'll give you this much, that, and this and that, right? So somebody has to bear this cost, right? Which we are trying to hold this person to us. trying to avoid him getting to some other carrier. So this is called cost to retain the customer. We are trying to give all these things free to retain this customer. We bear the hit. All right. So cost to retain the customer is trying to retain the customer which is getting away. And all the other costs which are not directly related to the customers, we call them overhead, like IT cost, finance cost, legal, executive cost, facilities, HR. They are all overheads. So overhead is now being classified as cost to serve, cost to acquire, cost to retain, and overhead. That becomes your total operating expenses. All right. Everybody clear with this concept? This is
Yes,
what you
sir.
have to speak in the interview. All right. Then
Yes.
we know that you're talking about some keywords that we speak for the management reporting. Then we come down over here, we see further terminologies over here, which we should be really learning. We have new customers, we have got churn. Now, what is churn? Churn is something when your customer leaves you. When your regular customer leaves you, that means he churned out. So, how many customers are leaving you? That's churn rate. So the companies monitor the customer's churn rate. For example, if now I'll give you an example when we sign the contract first, okay? Let's say you sign a contract for 2 years with some company. When you sign the contract, at that point they say you have got 14 days to back out. All right, no question asked. You can return the phone, and you will not be billed, and you are not in any binding contract if you back out within 14 days. So on the day when you sign, from that date to the 14 days, that period is called cooling off period. It's a cooling off period in which you stay there and you can decide whether you want it or you don't want it. Now, if you say that I don't want this product before 14 days expire, we call it leaked out. You leaked out. It's a leakage. Somebody also monitors this leakage percentage, that if somebody became interested in our product, what happened in 14 days that he does not want it anymore. So we can make it better so that people stay rather than leave within the 14 days. So companies would like to monitor those things too, so that they can increase the sales, right? If the leakage percentage is high, almost 100% are coming in and leaving you, who is going to serve? Who's going to sign up for your activities? So we have to control the leakage as well. In our companies, we used to call it leaky pipe, but most of the companies call leakage. They came into the pipeline, they leaked out. All right. So that leakage percentage is also being monitored, and somebody analyzes it and tries to make it better. Okay. Now after 14 days, you are in a binding contract for the next 2 years. If you leave before the contract expires, you have to pay some penalty, right? You cannot break the contract like that. So you have to pay penalty, you have to pay for the phone cost, things like that, right? If before the end of the contract I try to leave, that's called churn. I churned out. Your normal customer who was paying you monthly is now churning out. So anybody who leaves before the end of the term, we call churn. So we monitor the churn rates, how many people are churning out after signing up, and during before the end of the period they're going away. Obviously there must be a valid reason for them to go away. Either they're getting a better product somewhere, or they're getting a better price somewhere, or our services are not good anymore, or our product is lousy now. So we have to do something to make it better, to make them stay, right? So companies monitor the churn rate and the reasons for the churn rate as well. That churn rate is there. Now again, there's something you see here: renewal churn. What is that? After 2 years, company would like you to renew the contract for another 1 year, 2 years, right? And they give you a very good pricing promotion for that. And still you say, no, I don't want to come with the company, I don't want this. That's called renewal churn. You churned out at the time of renewal, right? You were there throughout the period, but then you don't want to renew it. That's called renewal churn. Company would like to monitor why people are not interested to sign up another term with us, although we are giving them so much incentives. What's wrong in there? Why they want to go to the competitors? Why they are not coming with us? So that's also something the company would like to monitor and address the issues accordingly. So renewal churn at the time of renewal. So now you know these terms. What is churn? What is renewal churn? What is leakage? Right? What's cooling off period? And what is CTS, CTS, CTR? Now for the churn rate, If it's not a subscriber based company where you're signing up, let's say take the example of Walmart or any store that measures how many people walk in every day. Let's say Walmart says that every day 5,000 people walk in into Walmart for whether they make the purchase or not doesn't matter. They walk in 5,000 people. Now they see that only 2,000 people are walking in, not 5,000, which means 3,000 are churning out, right? Because once they walk in, they would like to know how many people are out of those people really purchasing something. So they will do the analysis on that part as well later on. But right now, they are seeing how many people are walking in, and if the number of people walking in on average every day reduces, that is called churning out. That these people are churning out, going somewhere else, right? So these terms can be applied in any type of businesses, right? So now you know what is churn rate, what is renewal churn, what's leakage, what's CTA, CTA, CTR, and what's overheads. There's another term which the companies monitor, which is called RPU, ARPU. All right, that's a very common one. Bell does it, right? Most of the subscriber-based companies do it, but it is applicable to any business. ARPU. It stands for average revenue per unit. What is the concept behind it? Average revenue per unit or per household, whatever you want to say, right? Now, the concept is that if, let's say, Bell Canada is providing four services: landline, internet, cell phone, and telephone. And TV. Each of these services is costing you $30, right? So, $30 for cell phone, $30 for internet, $30 for TV, $30 for landline. If everyone starts subscribing only one service from Bell, average revenue per person of Bell will be $30, right? If every customer only subscribe one of these services, then he will be paying $30 to Bell. So on average, everyone is paying $30 to Bell. That's too low. So Bell will say, we are providing four services. Why these guys are not buying at least two or three of them? If they were subscribing two of them, average revenue per person would be $60. Three of them, average revenue per person would be $90. So management would like to maximize average revenue per person. Why can't they buy three of our products? What's wrong in them? So they would like to analyze why people are not buying more than one product from us. Why they're going somewhere else, right? When they're interested in one product, why not? So they will analyze which product they're interested in and why they're not interested in the others. How can we make them attractive so that they can buy at least two or three of them? So our average revenue per person goes up. This average revenue per person concept is applicable in any business, right? So every business wants each customer to maximize whatever he can pay to us. Now take the example of Walmart or any other grocery store that you go to. As soon as you enter with the cart in there, you will see at the entrance very attractive things. Let's say you went there just to buy eggs and bread and butter because you think that tomorrow morning I'll need them. I need some milk. I need better. You never went there to buy anything else, right? Now, as soon as you enter, you see right at the entrance some items, very attractive ones, discounted ones, right? Special promotion, right? And you never went to buy them, and you say, "Oh, this is a good value. Let me take it." So you put it in your cart. Now, all the essential items which they know people will need it, they will put it right at the end of the store. So you have to walk through the aisles to reach there. You'll never find eggs and all the essential items in the beginning of the store. It will be all at the end of the store. So you're walking through the aisles. Now, while you are walking through the aisles, on your side, you'll see many attractive items, all asking you to buy. So you see, oh, this is good value, this is good value. By the time you reach there, you have already filled up your cart with quite a few things, which you never came to buy, right? Similarly, they also do something eye level. You know, they keep certain items for the older people at their eye level, for the kids at their eye level, so that they can see it easily and they can be induced to buy those items, right? Now, you are now coming to pay, and while standing in the queue on your side racks, you see many things, magazines and battery cells and confectionery and all those things, right? So you still might be induced to buy those things as well. Oh, I might need this, I might need that, which you never came to buy. So what exactly they're trying to do? They're trying to maximize revenue from each one of you so that you can spend maximum amount on purchases so that their revenue increases per person walking into at least $100, $200, right? That's what their aim is. And that's how they do it because they will design it that way that by the end, when you're coming to pay, you have much more items than what you came for. So average revenue per unit is a concept which every company really applies, and obviously, naturally, everyone wants to maximize their revenues, right? So you now know many terms by which we can do the analysis work, and you can speak on them. What type of analysis were you doing? So any questions so far? We have discussed all these terms that we will be putting in your resume as well, and you should be able to speak on them, and you should make note of these items. That because the more keywords you speak like these ones, the more you are portraying that you have good knowledge what goes on in the multinational companies, and you are aware of these things so that you can easily adopt to whatever things they might be doing at their workplace. All right, so now we know what this flash report looks like. Let's say you're sitting in Canada East, so we are on the Canada East flash report, and let's say now that you are responsible for sales and marketing and operations, these three items there. So sales people will be looking after their own items. They will be commenting on their sales. Even it is possible that gas could be somebody else, electricity could be somebody else, right? Similarly, all these items, one person can never really tell everything about this. So each person will be responsible for their areas to write high level comments. Now let's say you are responsible for sales, marketing, and operations. You should be expecting these numbers when the flash report comes out. This should not be a news for you or a shock for you. Because just before the end of the month, you must have seen your reports. You must have seen what the numbers are sitting in there. You must have seen the variances in there. You must have already investigated and known the reasons of the variances. You must have already done the accruals and prepayments and all the cost allocations and correcting entries. So you know the final numbers are going to be this after all these entries. So you should be not having any surprises. You should already have all the information that you have. All right. So what is my role as a financial analyst is just to write my comments on my own areas. So every company does it differently. Some companies, what they do, they will log this part so nobody can make the changes on the numerical values here, and they will leave these columns on the side for you to write the comments. All right. There'll be a like over here they will have some items that you can write the comments in there. Some companies, what they will do, they will ask you to write the comments at the bottom of this flash report, and you just create the name of your department and you write the comments. So everybody will be writing the names of the departments there in comments. Some companies will say, okay, I'm not going to allow you anything on this page. You just copy and paste your area, write your comments and send it back to us, and then we will arrange it. Right? So you have to see in your company what they do. Like for example, in our company, this report was totally logged. Everybody was copying their portion of the report and writing the comments and sending back to them. So in the same folder for student 1, you will see a file called Alberta Comp AB Comp month end cost center variance. Right? That is a part of the flash report that we are responsible for, and we write the high level comments on them. So when I go here, so you can see we just copied and pasted our part over here, right? And now these are the high level comments. Now let me describe you what high level comments mean. High level comment means they just want an idea. They don't want details. For example, if traveling cost is lower because less number of people traveled, and less number of people traveled because we are closing an operation over there, we're not interested anymore, or whatever the reason may be. So the high level comment would be traveling cost is favorable due to lower number of people traveling. Full stop. How many lower number of people? Why lower number of people? No need to tell anything. That's what the high level comment means. This means that I know that two people less traveled or lower number of people traveled. I will give you full detail later on in coming reports. But I know that this is a valid number. Traveling cost went down because fewer people traveled, and that's what the reason was. And I will tell you further detail for it in the detailed reports. That's high level comment. A detailed comment would say traveling was lower due to two people traveling less as compared to plan due to these factors. Right? There we are giving full detail. That's your detailed comments. So there's a difference between high level comments and detailed comments. Now look at that area here. We are putting the high level comments over here, and you can see the big variance over here for bad debts. And only one line comment is there, bad debt higher due to change in the calculation method. We change from income statement method or revenue method to the AR method, and that adjustment is because of that. But we are not mentioning anything about which method to which method and why. We're just saying bad debt is high due to change in the calculation method. That's a high level comment. Lower salary expense 104K due to two unfilled positions, lower staff related expenses, and lower BC advertisement. Why BC advertisement is lower, whether we'll be using it in the future months or not, why staff is lower, why salary is lower, we have no idea. At this point, we have the idea, we know it. But for this purpose, in the comments, by reading of it, you will have no idea why this happened. But the person who is writing the comments knows it, and he's going to provide it in the detailed reports. That's the high level comment. Okay. So your role will be done once you have taken out your information and provided the high level comments on your area, and then you're absolutely sure that everything is fine. Your role is done until somebody comes back to you, asks you some questions on it. So if the senior manager thinks that your comments are not valid, or something is wrong in there, or something needs to be changed, or not sufficient, give more comments, then obviously you will do more. Otherwise, your task is done once you provide the high level comments to them. Everybody clear? What is your role? Just putting.
Yes, sir.
And you have to put the high level comments from the month and year to date. Now, first of all, I would like to tell you one thing to increase your confidence level. Reporting, in my opinion, is the easiest task in the world from your point of view, from financial analyst point of view. Why? Number one, you are not creating, if I go back to the flash report first, you're not creating the structure or this report for the first time. This structure is already there. All the formulas in there, you're not putting any formulas. They're already there. You'll see that when I show you the senior role when we update this report, okay? You're not creating the model, you're not creating the formulas, you're not even typing any formulas in there. You're not even creating these numbers. These numbers are based on the input in the system, which is done by many people. Accounts payable persons are putting invoices in there. Other people are putting their numbers in there, right? You might have done few numbers in there for accrual or prepayments or cost allocations, or maybe some entries at the end of the month. Few entries may be there for you from you as well. But these numbers are not typed, not generated by you. It is coming from the system, which is made up of many, many entries from different people. So how difficult can that be to update this report just from the sources given to you? We'll see when we see the how to update this report. So easy, right? So numbers are not done by you, structure is not done by you, formulas are not done by you. All you need to know is if it is your role as a normal analyst, once this report comes in, you should be able to explain your variances. And now these reports are there with you throughout the month. You can easily see what's coming in there. Again, every entry is coming from different people. You just have to go and see what's coming in there, interact with different people, and find the answers from them. You're not even investigating anything. You just go and contact the person concerned and ask them what's happening here. and they will tell you the story behind it, right? If you want to find something from the system, you can go to SAP or system and see in the actuals, all the invoices, everything is there, which tells you how this number is being calculated. So you know the working behind this number as well. So everything is done for you. So how difficult can that be? It's just that your Excel and your system has to be strong. That's it. If you can guarantee that, yes, give me anything in Excel, I can read this formula, right? Let's say if you see any formula in some kind of, let's say, right, you can read this formula, you can see where the numbers are coming from. Give me any formula, I can read it. I can read the source by reading the formula. If you can be strong in your Excel, and if you are strong in your system that they're using, you can do any task in reporting and budgeting and planning. It's the easiest task in the world. All right, provided you know your tools. If you don't know your tools, then yes, it is the most difficult task, because then you'll be wondering around what this formula means, how to update them, where to go and find. Then obviously, if you have no idea how SUMIF works, what exactly it is saying, then you have a problem. You'll not be able to read the source files. You'll not be able to update them, because once you read the source file, it might be going through many layers. It might be taking you somewhere else, and then from there you have to go backwards, then backwards, then backwards. Ultimately, you will reach your source file. But if you don't know how to read your Excel formulas, obviously you have a problem there, right? So if you can guarantee us, yes, your Excel is strong, your system is strong, then absolutely, I'm 100% sure you'll be a success. All right? There's absolutely no reason for it. All right. So this is your role as a financial analyst from the normal financial analyst point of view. Your role is done. Any questions now? You can ask me questions from practical point of view if you have any, before I tell you the senior role in this one. Everybody okay with that?
Yes, sir.
Now the key to learning is that during the week, open this report, right? Open this flash report. Take one of the report, east, west, or whichever. I'll prefer east because we were in east, a lot of information is there. Take the east and tell yourself, if I'm looking at this report here, what are the contents? How would I update this report? If I'm giving this whole report to update, where the numbers are coming from, how would I update this report? What are the contents of them? If they ask me anything about this one, how would I explain them? All these things. What is turn? What is this? So once you revisit it and you make your notes and you see that, okay, this is what I can say in the interview, then you will feel very confident, because this report structure will come in your mind, those items will come in your mind, and you will know what to say about each item in this report, what exactly your role was. All right. So the learning is always when you look at the report from the point of view, let's say it's given to me to update this month, how would I do this? Okay, just a minute. Right, somebody asking me any questions, anyone? So everybody okay? Sorry, there was a phone call. I was just attending. Some student wanted to some time because he has some problem to submit tomorrow. So he was asking about something he's creating. All right. So any question, anyone, on the role of the financial analyst and the contents of the flash report, the purpose of the flash report, and the timing of the flash report, your role? Everybody clear with all those things?
Yes, sir.
Right. Okay. Now let's see what is my role as a senior analyst. As a senior analyst, you will be responsible to populate the whole flash report. This one, the whole thing. All right. You will be responsible to make sure that all the numbers make sense, your variances make sense, your percentages and the totals make sense, and this report is complete, accurate, and valid. Before you leave it on the shared drive for people to write their comments, high level comments, that is your role now. You are asking people to write the high level comments. You are not supposed to know whether these numbers are right or not. You're not supposed to know what is the reason of these variances. You're just supposed to know whether these numbers are complete, accurate, and valid. Now, in any report that you are responsible to update, You have to ensure that the reports are complete, accurate, and valid. These are the keywords. And in interview, when they ask you about your reporting experience, you have to mention that I was updating the report on a monthly basis using BI, SAP. You have to mention those softwares that you were using to update or from other people's files and folders. And then I was ensuring that the numbers in my report were complete, accurate, and valid. Unless your numbers are complete, accurate, and valid, you cannot really write the comments if they are not complete, accurate, and valid. You will be really analyzing wrong numbers. So what do we mean by complete, accurate, and valid? That's what we have to know now. Complete means that this report is populated completely. Nothing is missed. If this item is there, was supposed to be there, and there's nothing over there, it's not complete. Right? That's one thing. Everything has been posted over here. Nothing is missed. Plus, if any item has to be posted over here, let's say 153 is appearing over here, but it should have been 240, then it's not complete. Something is missing, right? So complete means all the postings, all the entries have been made, whatever was supposed to be made, everything is done completely. Everything is done. Nothing is missed. That's complete. Accurate means item is populated over here accurately in the right category. Marketing is not shown in the sales. Transposition error is not 29, 92 is not written as 29, right? So that's called accuracy. Everything is accurately reported at the right place, and there's no transposition error, there's no error of formulas, totals, percentage totals. It's all accurate. The percentage formulas are all right. Your variance formulas are all accurate. All right. There's no mistakes in the formulas there. That's complete and accurate. And valid. What does valid means? Item can be complete. Item can be accurate, but it might not be valid. All right. So, what is the example of the invalid items? For example, if I'm seeing any inventory items over here, it could be complete, it could be accurate, but some items in inventory should have been written off because they're damaged items or they're obsolete items which will never be used. We should have got rid of them, but they're still carrying on in the books. So, although the item is complete, accurate, but they are not valid, they should have been written off. Secondly, if we have checks written right, and we have outstanding checks which are, let's say, more than 6 months old, and they are still included in my records here, then records are complete, they are accurate but not valid because we should have written them back. So things like that we have to ensure, right? So complete, accurate, and valid. So now once we know that this is my role to ensure that this report is complete, accurate, and valid, and then after this is complete, accurate, and valid, I have to ensure the reasonableness of the numbers there, and then I will leave it for the high level comments for people to write. Once they write the high level comments, I will receive it back. My role will start again. So let's see my senior role in this. How will I update this report? Let's say I am responsible for Flash East only. If you're responsible for all of them, same thing will work whatever we learn over here. I am responsible to update Flash Report East here. Alright? So if you're doing it for the very first time in your life, and you are new over there, what you will do, you will put your cursor on each item and you will see where it is coming from. And then you will make a note of all these items, the sources from where you have to go and update it from. Right? So if I look at this formula, first one here, it is a sum if formula. And sum if formula is saying go to the file FO9 actual. And in that one, slash east is the same file as this one, slash east. This is the tab here. So the main file that is coming on is FO9 actual. And since it's not giving me C drive, D drive, E drive, this FO9 actual must be somewhere in the file over here, in the same file, FO9 actual. So it's a matter of finding FO9 actual. So I write on my paper, FO9 actual file I have to find, or sheet I have to find where it is. If you go further down, you will see FO9 actual somewhere here. That's FO9 actual, right? This is the one. So I have to update that one, right? So I write down numbers are coming from FO9 actual in China East here. If you don't see FO9 actual over there and you don't see C drive, D drive, you have to right click and say unhide. And it might be hidden somewhere here. Then you can unhide it and then you can update it. So sometimes you might not see it over here, it might be hidden file, hidden sheet. All right. So I will go through every item like this all the way down, and I'm seeing everything is coming from F09 actual. I'm happy. Otherwise, it's all plus minus that I don't care about. Formulas I don't care about. But these formulas, some if F09 actual, I'm just making sure that F09 is the file only source, or is there any other source too. So I'll go all the way down. This is something different. Now this is VLOOKUP. VLOOKUP again, it is on F09 actual, so I'm fine. Okay. If I go and F09 actual, it will all be updated. Okay. So this is how we do it. Okay. In the senior role. So you have to first find the sources from where you have to go and update those numbers. So again, we look up F09 actual. Everything is coming from F09 actual. I'm happy that. So the first column E is all F09 actual, right? So I'm happy that, okay, that file I have already located. Second one, F09 LE2, right? Again, you will go all the way down, you know, down sources. I know that it's all F09 LE2. The third one is F09 plan, right? And fourth one is F08 actuals. So four different sources to update four different columns all the way down. Then what about this? This is the same F09 actual, F09 LE, plan, actuals. So now we know that if I update those four files, all these numbers will be updated. Then my task will start to see whether they're all complete, accurate, and valid. So first I have to update those things, okay? So I go back to those files. See, I'm telling you how easy it is. You're not creating anything in here, it's already there. So I go to the F09 actual and I see, oh, this is a BI report. We have done BI. I told you that BI looks like blue and dark blue. BW, the older version, will look like gray and dark gray. All right. This is the BI report. Oh, see, oh, F09 actual is BI report. You see the plan. Oh, that's also BI report. F09 LE2, that's also BI report. F09 actual, that's also BI report. So these are four BI reports that we have to update. Once we update this report for this month, my numbers in my flash report will automatically update. And then all I need to do is to validate whether everything from the BI report is populated over there, everything is complete, accurate, and valid. So let's see how do we see that. What you will do now, you will come to F09 actual, you will go to your BI, you will log into BI. When you log into BI, it will ask your password and ID. Once you give that, you will be logged into BI. All you need to do is to click on the refresh button. There's a refresh button there, right? When you click on the refresh button, the dialog box will come up with the variable values already selected in there. Cost centers, company code, fiscal year, month, everything is selected. In that month, it will say, let's say you're updating for period July, and this report is for June, let's say. Then in that variable values, it will say June report. All you need to do is just change the month from June to July. That's it. All other variable values are already selected for you. You just have to change the month. I want to update this one for this month, July, and say okay. All these numbers will be updated for July. All right. You do the same for the plan. Log into BI, update for the month of July. Same here. Log into this, update for the month of July. Update for the month of July. All of them are saying June. Now they're all July numbers. Once all these numbers are updated, you have to ensure that all these numbers are being updated in my report as well or not. Calendar is here. So now three things: complete, accurate, and valid I have to check. If I can check those three things, then I can start my analysis work. Alright. So in order to see the completeness that everything from the report that I updated is coming over here, we have checks over here. Check. And you see calendar East text, Alberta text, BDC text. If these numbers are zero, after you update the reports, as you can see, if you can read the formula here, F09 actual minus Canada East. If this is equal to zero, then it means the total grand totals I have already, if they match, I have already updated everything from the files to my files. So we have to ensure that the texts are zero. If these texts are zero, I am sure that whatever we have in the reports of BI is populating my flash report over here. So we have checked the accurate completeness of the records here. Everything is completely recorded over here. If any new item is coming in my reports of BI and they're not populated over here, I'll see the difference over there. Then I have to resolve that issue. All right. So completeness is checked. Then accuracy. Are the numbers going into the right place? They are all accurate or not? Since they are all coming by the sum if formula or the VLOOKUP formula, there is no chance of error because sum if will only bring the number if the criteria is met. And the criteria is clearly defined. It has to be gas, it has to be electricity. If it was linked numbers, then there could be chances of error. If there was a linking, because linking, they can change the linking of the cells and my cell might be reading a wrong link. But since it's not linking, I don't have to recheck. It's all accurate and complete because everything is coming through the formula that will ensure the accuracy. You understand that VLOOKUP cannot be wrong, right? It will only look that item. If that item is appearing, then only it will bring you. So it cannot be populated at the wrong place, right? And it will be populated from that number, so it cannot be wrong. There couldn't be any transposition error because you're not typing anything. You're straight away getting it from where it is. So there's no chances of transposition. There's no chances of wrong place or populating a wrong item at the wrong place, right? So we have ensured completeness and accuracy. How do I ensure the validity of the numbers? We also have to make sure that these numbers are valid. Now, you see why validity can be questioned? See here. I hope everybody is understanding me. If I'm updating, let's say F09 actual, and when I log into BI, and in the BI I select instead of period 7, I select period 5. I'm just thinking of something, I'm under pressure. I did not type 7, I think I typed 7, but I typed 5 and I said okay. All these numbers will be populated for period 5, right? When all these numbers are for period 5, they will all be completely updating my numbers over here for period 5. So my numbers over here will be complete and accurate, but for period 5 not valid. So they are complete because still it will show 0 and they're all valid. Sorry, they're all complete and accurate because everything is coming to the right place, but the numbers are not valid because the month is not valid. So how do I check the validity of the numbers? So first of all, when you are someone who is older over there, who is experienced over there, you will be expecting certain numbers for revenues, certain numbers for margins, for certain percentage of margins. That way you will know numbers don't look good because you know that this number was somewhere earlier. It should have been much more than this number 5. The 336,000 year to date should be much more as compared to what we have here now, this period 5 numbers, right? How do we check it? We can go to SAP, we can run any cost center report or any revenues for that period. We can see the GL account and we can find out whether the numbers are the same or not. If I run the report for period 7 in SAP for any cost center and I match with my BI report over there for that cost center, it will tell you exactly whether those numbers are the same or not. If they're the same, I'm sure that my numbers are fine and accurate and valid. If they're not the same, then I made a mistake, I'll correct it. So that is your role as a financial analyst to update this report, senior financial analyst to update this report from different sources from where it is being populated and make sure that it's all complete, accurate and valid. Remember, companies will not want you to waste your time on updating the report. That's why you can see all the formulas. Everything is already there. Checks and balances are also already there. Your report has already been attached with the BI reports. All you need to do is just change your number for the month. Your report is done. The only time it takes is to update it, and then you can easily validate those numbers. That shouldn't be taking much time in there. So it's so easy, right? So once you are sure that this is complete, accurate, and valid, then your role starts again. You have to analyze this number. How? You although have no idea what the number of the revenue should be, but you know what is the trend. On average, if your revenue is always 18,000, 20,000, something like that, and all of a sudden you see 30,000, 40,000 there, then you should raise an eyebrow. This is not a normal number. If your percentage of margin has always been 30%, 20%, something like that, and you see 50% or 10%, then something is wrong. You should be questioning what's here. If you see big variances over here, abnormal variances high or low, you should be highlighting why there's so big a variance. It's never been like that before. So because you have to do the trending with the previous periods to see what on average the numbers for the previous periods have been, what the grand totals or the variances or the percentages have been in the past and what should have been in this month as well. If you see any abnormalities, then those are the things that you have to mention or have to address. If you post this and this report on the shared drive, asking people to write their comments, they will laugh at you that the numbers are not right. So we have to ensure that all these numbers make sense and they are all complete, accurate, and valid, and they percentages, totals, variances, they all make sense. Now let's say if you see that the gas, electricity are too high as compared to normal trending, some items over here in the cost center report, cost to acquire, cost to serve are too high as compared to and too big a variance to understand. You will not try to do anything on it. All you need to do is to contact the person concerned and tell him, I am seeing bigger numbers or lower numbers as compared to normal trend. Do you have any reason for it? If he says, yes, I have a reason for it, then he can tell you, you can write a small comment over here that this number is higher due to these factors. So if they have the valid reason, we will not question anything else. We'll just write high level comment over there. We'll ask them. And if they don't have any reason, then we want them to correct it. Otherwise, we don't want to issue a wrong report. So that is your role here, to see any abnormalities over there, any percentages, any totals, any number trendings. They're all making sense or not. Once you have done that, then you will leave it on the shared drive, sending a note to all the person concerned. Please write your high level comments by tomorrow, and it will be closed on such and such date. So everybody will write the high level comments once, and you will receive them. Once you receive them, now your role starts again. You are a senior analyst, okay? Now you have to read the comments of every item that you have received. You have to make sure that the comments is really explaining what we have the variances over here. If they are not sufficient, you have to go back to them, ask them to write more comments on them. It's not sufficient, right? If you think that they're okay, you let them go. Now, sometimes you might see that the comments are written in wordings which are not professional. Spelling mistakes, grammatical mistakes are there. You have to rephrase them. Sometimes they have written too much detail. You have to remove those details and then write them concise and precise sentences over there for them. Sometimes the analysis I've done for smaller items which are not required. You have to remove them. So basically, you are making it more easier for the management to read. So you have to transform the language. You have to make the comments easier to read with more professional wordings and removing spelling errors and grammatical mistakes, and make sure that all the things are explained properly so management can take the decisions or can see what things are what's happening in the company in that month. All right. Once that is done, this report will be saved by another name called Outlook report for the top management to view. Once as a senior financial analyst, you have done all this before we make it available to the senior managers. You will talk to your immediate manager, tell him all these things. He will review with it. He will review all of it with you. And if he needs any more explanation, he will ask you questions. And you might have to go back to the respective persons to get some more information. Otherwise, we'll finalize this report for the top management. That's how it is done. All right. So you have seen there's nothing technical over here, no accounting knowledge required. There's nothing, there's only monitoring, and your systems and tools have to be strong. Anybody can do this task, right? It's more responsibility for the senior analyst role because he can understand the numbers better, he can understand the trending better, he can understand the variances better, and he can write professional wordings better. As a junior analyst, anybody can do this task. You have to just take care of your part. So that is your flash report that we have just seen. Any questions on that? When we come on the scorecard, we'll be doing full detailed report in the scorecard. There's no junior or senior level role here. We'll be seeing how to update this report, how to ensure it's all complete, accurate, and valid, and how to analyze this report and how to write the wordings. We'll be doing full in detail this one. Whatever we learn on the scorecard will be applicable to any report given to you to update. So now today we have completed the flash report here. In the next class, we'll start with the dashboard. Dashboard is a smaller report. It will not take much time, so we'll start on the dashboard and scorecard in the next class. So flash report is the one that comes out soon after the month end. We saw the purpose of it, and we saw your role as a financial analyst and as a senior financial analyst, right? So it's better to prepare right from here right now, because otherwise it will be too much to prepare at the end of the day. During the whole week, you have the whole week to prepare yourself for the flash report. Tell yourself how would you update the flash report, what are the contents, what's the purpose, what key factors are there in there, how will you ensure it's all complete, accurate, and valid. So be prepared for the flash report. If it's in your resume, you can speak on that. All right. And tomorrow, next class, we'll be starting with the dashboard and scorecards. So any questions, Yasir, Christine, Pradeep, Simranpreet Kaur?
We have to work on it, sir.
Hmm?
No, sir.
Okay, no. All right. Pradeep, you said something?
We have to work on it, like,
Yes, yes. Actually, believe me, every company has the same thing. All the big companies, we're targeting you for big companies, right? So in
yeah.
all these companies, these keywords, all these reports, that the name of the reports, the work that we do over there, it's all
Mhm.
very important for you to portray your knowledge in your interviews. Then when you join them, they will be telling you all those things. You will be able to relate, oh yes, I've seen that before. I know what they're talking about. Rather than not seeing it at all and then being exposed over there and just wondering what they're talking about, right? Now you're
Yes.
taking this experience with you.
Yeah.
All right.
Okay, thank you, sir.
Okay, thank you very much. Yesterday,
Thank you,
some,
sir.
some people were not there, so I sent the recording for yesterday's class. So yesterday we finished the month-end activities, and in next class, remind me, I will give you the accrual prepayments, bad debt provisions, some exercises on that. Okay.
Okay.
Okay,
All
sir.
right.
Thank you.
Thank you very much,
Thank
everybody. Take care. Bye, everyone.
you.
Okay, good night.
Good night. See you.
Good night, sir.
Right.